Holger, let me first kick off with what we're seeing in the financial report from the ECB. Look, they're saying there are challenges to the financial stability, amid these downside risks to the economy. How worried are you about Europe in general?
I'm not very worried about financial stability in Europe, and I'm not very worried about the economic situation. We are having modest growth. The period of modest growth may continue for a while if trade tensions don't ease, but we do not have imbalances within the Eurozone of the scale that we had ahead of the Lehman crisis and ahead of the Euro crisis. So if something goes wrong, unlikely, but if something goes wrong, the consequences of that in financial markets would probably be comparatively limited, with the one exception: if Italy chooses fiscal suicide, which is an Italian choice, then of course things might be different.
Okay, we'll get back to that possible Italian fiscal suicide, but in general there's so much concern, Hans, and actually, look, the ECB just doesn't have the tools to deal with the next downturn. That's fair.
Well, it's maybe fair, but it says also that Europe has now to go ahead with this integration process. So what Europe does require is safe assets, and that allows a better flexibility of the European Central Bank. But I would like to add what Holger said, namely balance sheets in Europe, and they are strong, and you could even argue that they are maybe too strong. So when you look at what Mr. Weidmann said a couple of weeks ago or 3 weeks ago, in which he was citing the current account surplus we have developed in Europe, and how that was emerging, that we have obviously in the corporate sector significant savings made, and he is saying we need to change matters. We have to go for more investment in Europe in order to get our current account surplus in order, meaning lower. And I think that is going to be one of the upcoming topics. Now you look into the United States, which has gone completely the other way. Yep. So its balance sheets have weakened, its corporate sector has increased its leverage in a significant way and has reduced its equity in a significant way. And that
so
obviously...
You're telling me that if there's a downturn in the next 12 months, the ECB has the tools to deal with it.
I think
no question about it.
For the time being, the ECB, I think, is in a comfortable situation simply because the European fundamentals are not looking as bad as people think.
Right.
But concerning the
tools... There was a soft patch, so you think the soft patch was a blip and it's coming back up?
The soft patch is related to what happened in China, the global trade situation. We are manufacturing driven. It is hitting especially those economies which have a significant manufacturing exposures. When you look at others, which are more domestic demand driven, more service sector driven in Europe, those economies have been doing better. So I'm not denying the problems, but the issue here is that Europe has to take one very important message here home, and that is it has to aim for political and fiscal integration. And it has then, by that process, it provides the European Central Bank with a tool to react in an economic downturn.
Do you agree?
I largely agree. European fundamentals are in significantly better shape than many people give Europe credit for. You see that actually in one important thing. While there is a recession in industry in the Western world, including in Europe, European domestic demand, business investment, consumer spending, government spending is holding up nicely. So Europe is in much better position to resist the shocks, which means the ECB would not have to do anything drastic.